Just released its 2017 Global Private Equity Report. Hugh, what was the biggest surprise for you?
Well, Jason, I think the biggest surprise is the continuation of a lot of the trends that we saw in 2015 going into 2016. Fundraising continued to be very strong in the industry. Returns are up and very strong as well. And the deal making has been very, very difficult because of tremendously high prices that have continued to persist in the industry, really providing a lot of headwinds for our investors trying to get a lot of money put to work that LPs would very much like to see them put to work.
Well, that's exactly what we're hearing sort of in the corridors here. Let's talk about fundraising for a second. Especially for the mega buyout funds, the most mega buyouts, $5 billion plus funds raised since 2008, so really since the crisis. How long can this go on, this robust fundraising environment?
Well, it's going to get a little tougher. We call this the elephant and the snake problem. The huge amount of deals that were done, the record amounts in 2006 and 2007 have been monetizing over the last 4 years. And as LPs have had their coffers filled with tremendous amounts of cash from that, they've wanted to put money back into the industry because the returns have actually been much better in the 06 and 07 vintages than people feared. And so as the fundraising markets have been very strong, putting that money back into the market over the last few years, we've now seen kind of the elephant pass through the snake, if you will. And so there'll be fewer distributions to LPs going forward. And of course, I think everybody's thinking that it's a bit late in the day in the economic expansion. And at some point over the next 5 years, we may have a macro shock of some type that may drive returns down. So we may find kind of a perfect storm here in the future of less cash flowing to LPs and returns being compressed by adverse macroeconomic conditions. And that will lead to potentially tougher fundraising environments down the road.
Interesting. So you mentioned a challenging deal-making environment as well. Valuations seem to be extraordinarily high. We've had a huge run-up in the U.S. stock market, especially. What's the outlook there for the rest of the year?
I think, deal making will continue to be tough because prices are going to be high. We have record amounts of dry powder in the industry, well over $1 trillion. We have a tremendous amount of what we call shadow capital, which is institutional money that's in the form of co-investment and co-sponsorship that's also there. That adds about another, in our estimates, 15 to 20% to the dry powder that's already in the marketplace. So the amount of equity chasing deals is huge. The number of companies to buy is not growing at that rate. And the amount of cheap debt is still actually quite plentiful. So the prices are going to remain very, very high into the future, and that just makes it tough to pencil out the kind of returns that GPs and LPs expect.
One of the areas you pointed out in your report is technology, and just a huge amount of money chasing those deals and deals getting done. What's behind that?
It's interesting. 7 of the largest transactions in 2016 were in the tech space, both on the software and on the hardware side. I think technology offers a couple of different ways to add value that GPs are really attracted to. One is, particularly on the software side and the service side, it has the kind of growth rate in many of the subsectors that will support the kind of multiples required to buy these assets. If I have a double-digit growth rate that I'm confident is going to continue well into the future, it makes me feel better about paying up for a good asset. On the other side, we're seeing a lot of maturing technological spaces, particularly on the hardware side, where the play isn't so much rapid revenue growth, but is reasonable revenue growth, but potentially with a lot of cost improvement because the go-go years of growth are gone and we haven't really focused on the cost structure while we were growing really quickly. But now it's time to get more efficient, focus on the cost structure, and get more lean, and that's a way to add value as well. So the tech sector has really been very attractive from those two perspectives.
Excellent.